In this mini lecture, we focus on the management and analysis of accounts receivable, one of the most important current assets within working capital. Here's the first part of the discussion in relation to accounts receivable, or you may prefer to call them debtors. These are our customers to whom we are going to extend credit terms. And so there's a whole process about giving credit. One of the things you need to look at is what is industry practice here, and if you don't provide terms which are consistent with industry practice, then perhaps you may lose customers who will go somewhere else where they'll get credit. We give credit because it enables us sometimes to capture sales. In giving credit, however, we know that we have the potential for loss, because as soon as somebody goes with our goods or our service without paying us, there is some finite potential that we perhaps won't be paid. Those costs we see in terms of bad debts and debt collection costs. Sometimes in order to collect the cash, we have to offer discounts, and we'll calculate just how expensive those discounts are in a little bit, in a few slides' time. The trade-off here is that sometimes by refusing credit, we may cause offence to otherwise good customers. And so we have to assess the credit risk, and there are a number of well-practiced basic steps in assessing the credit worthiness of a customer, and they're listed there in the dot points below. How much credit should we offer? Well, too much. It means that we have a lot of our cash tied up in funding somebody else's business. Too little, we limit our sales potential, and that may make us uncompetitive. So this is a balancing act, and we'll look at what typically happens within our industry. We'll look at how fierce the competition is, whether there's a customer who we particularly want to capture and hold, in which case we may be more amenable to giving them credit. We also have to assess what are the risks of them not paying. We need to understand our own capacity to extend credit, understand what our marketing strategies are, and understand what the cost of debt to us is if we have to use an overdraft in order to provide credit to our customers. We have to have a debtors collection policy which will encourage our debtors to pay on time, and if they don't pay on time, we have to understand what we'll do and when we'll do it in order to get that bill paid. We can offer discounts, which is very costly. We can restrict the collection period perhaps to 10 days instead of 30 days. We can make sure that our bill processing and inventory processing is correct and fast and accurate. Be certain of sending out reminder notices. Be in touch with our customers. Ask them if they haven't paid. Is there something wrong with our product? Is there some reason why you haven't paid us? And when all else fails, use a debt collection agency. And if we have to go to that extreme to use a debt collection agency, then we need to go back and examine why we were giving that person credit originally, and was there something wrong with our assessment processes. Now here's an interesting question. Sometimes it seems pretty cheap, doesn't it, to offer a 2% discount to get somebody to pay you a little bit earlier. Let's calculate what that 2% discount, in this case for being paid in 10 days instead of 30 days, what it actually costs us. So the example here, we're prepared to give a 2% discount. That's $2, I hear you say. That's not very much. Well, $2 out of $100 to be paid 10 days instead of 30 days. We can calculate what the annualized percentage cost of that discount is to us, and we can put it into that formula. You don't need to remember that formula, but it's instructive to look at what the answer is. The answer is that $2 that you paid out, or that you didn't collect, in order to be paid 20 days sooner, turns out to be an annual rate of 36.72 percentage points. When you sit back on your heels and you think about that, you think, gee, I could have gone to my bank and got an overdraft, perhaps at 12%. And here I am, I've just paid an equivalent of 36.7%. It didn't seem like very much, but it's actually a very expensive way to fund your debtor's policy. So don't do it blindly. Always look at the alternatives of what you can do in order to collect your money and what each of those alternatives might cost you. Let's look at some of the ratios you'd want to calculate now to determine the efficiency of managing your accounts receivable. There are two ways of looking at this. The first is to consider the accounts receivable as a turnover. Turnover is always measured as times. It turns over so many times. The question we're asking here is about how quickly do we turn over the amount which is sitting in our accounts receivable ledger. Now think about this. If you're offering 30 days credit, then logically you'd expect to be turning over your accounts receivable ledger 12 times a year. That's 12 times in 365 days. Let's look at it here in this example. We're selling $500. Now ideally you'd use the credit sales figure, but if that's not available, you have to use total sales. Look at the accounts receivable balance. In this case, that will come off your balance sheet, and in this case it's given to us as 50. How many times do we turn over the accounts receivable balance of 50 when it represents sales, unpaid sales, of 500 in a year? And the answer to that is 10 times. Now another way of looking at that is to say, well, there's 365 days in a year, and if I'm turning over my accounts receivable ledger 10 times in the year, then on average, my customers are paying me 36.5 days on average. And there's the formula for calculating the number of days on average that are outstanding. Now, how do you feel about 36.5 days? If your credit terms are 30 days, then you think, it's a little bit long, but it's not too bad. If your credit terms are 10 days, then 36.5 days on average is terrible. Why is it that the person who's managing this side of your business is not on the phone asking your customers to pay on time?